Informed Choice Radio, episode 225 with Phil Oakley. How to pick quality shares.
It's good to find companies that are not only highly profitable, but also are very good at turning those profits into lots of cash. One of the things that you should do to try and understand the business and keep yourself away from dangerous companies is look how a company's performed when times are bad, when there's a recession. Any company which has shown a lot of variability in its profitability, that's generally a sign of something that can be quite risky.
Sundial House Studios in Cranley, welcome to Informed Choice Radio. This is the podcast all about achieving your financial goals in life. Here's your host, Martin Bamford.
My guest on the podcast today is Phil Oakley, author of the new book, How to Pick Quality Shares. Phil is an investment analyst and private investor. He works for Ionic Information, the makers of the market-leading ShareScope and SharePad software for private investors. Phil spent 13 years as a professional investment analyst with 10 years working for fund managers and stockbrokers in the city. He left the city in 2009 and began writing educational articles for private investors. He was senior investment writer for MoneyWeek for 3 years before starting his current role. Phil holds the Chartered Institute of Securities and Investment Diploma and the Certificate in Private Client Investment Advice and Management. In his new book, How to Pick Quality Shares, Phil provides a 3-step process for analysing company financial information to find good investments. This process covers finding quality companies, avoiding dangerous or risky companies, and not paying too much for companies' shares. By applying the in-depth techniques described in his book, investors will have a fuller understanding of how companies really work and will develop an edge over other investors, including professional investors and analysts. Listen to the end of this episode to find out how to win one of 2 free copies of How to Pick Quality Shares. If you find the episode useful, I hope you do, please do take a moment to say thank you to Phil on Twitter, at Phil J. Oakley. Mention me too, please, at Martin Bamford. You can find the show notes for this episode at icradio.co.uk. There's also useful links, and you can also download the full episode transcript. That's all at icradio.co.uk. Here's my conversation with Phil Oakley, author of How to Pick Quality Shares. Well, I'm delighted to be joined on Informed Choice Radio today by Phil Oakley, author of the new book, How to Pick Quality Shares. Phil, welcome to the show. Thank you, Martin. Could you start by telling our listeners just a bit about your background and what it is you do?
Yeah, sure. Well, I think virtually to the day, I think I've been in the world of investing for 20 years now. And I started off back in 1997, my first job out of university as an investment analyst working for a wealth management company in Liverpool, which is where I went to university. And I spent 2.5 years there, essentially learning the trade. And it's where a lot of the ideas for the book came from, actually, because we were quite small investors, we were very, very self-reliant. We didn't talk to brokers, so we were taught, actually, with some very good teachers, to work independently through things like annual reports and company presentations. And we did go and meet the odd company and do that kind of thing. It was immensely valuable. Unfortunately, it wasn't particularly well paid. And after about 2.5 years, I was approached by a city stockbroker to go and be a transport analyst for them. And then I spent the next 10 years working in the city, 7 of those for stockbrokers, covering transport, but I also did food retail for a while. And then I spent 5 years working for a small companies team, which was very, very enjoyable and very informative. And then I spent the last 2 to 3 years of my city career working for a fund manager as an analyst on European shares. So I've done quite a broad range of analysis jobs. And about 7-8 years ago, I got a bit fed up with it, bit disenchanted with it all. I had a young family, and I decided to jack it all in and go and look after my 2 young children for a couple of years whilst my wife went back to work. And during that time, I spent some time thinking what I was going to do with the rest of my life. And one of the things that came to me was that I actually enjoyed writing, and I liked analysing, and I liked numbers. A lot of the things that I enjoyed from my old job without the stuff that I didn't. So I started up as a freelance writer, financial writer, writing for websites. And I was eventually offered a job by MoneyWeek magazine in 2012. And I worked for them for 2.5 years. And I ran a newsletter for them, which was very enjoyable. And I was then tempted by an offer from my current employer, which is Ionic Information, who make software, stock market software called ShareScope and SharePad, to come and work for them, writing educational articles, but also because of my analytical background, they wanted me to help with developing the product for them to make it better and more useful for private investors. So in lots of ways, that's my ideal job, a combination of writing and helping to make something better. And that, in a roundabout way, is how I got to be where I am today.
And you've condensed that 20 years of very broad experience, but specialist in terms of an analyst work in City and in different sectors, into your new book, which is How to Pick Quality Shares. You mentioned that first role in Liverpool was sort of the basis, the foundation of the book. What inspired you to put pen to paper or typewriter to paper and to come up with this book and share it with a wider audience?
Well, in all honesty, it never even really crossed my mind to write a book. Even though I've written a lot of articles for websites. I was actually approached by a guy called Craig Pearce from Harriman House about 18 months ago, who'd seen my stuff on the website, on the ShareScope website, and said, "We quite like this. We think there's a good book that could be made out of this. Would you be interested in writing it?" And I said yes, and that's essentially how the book came about.
Well, let's dig into some of the topics you cover in the book and give some of our listeners a flavour for what you're talking about there. Let's start with this. How can investors find quality companies? Clearly, that's what you've been doing in your various roles. So what are the steps? What do they need to look for to find quality companies?
There's like lots of things in investing. There's not a single right answer for getting to where you want to be. I mean, quite often you can stumble across quality companies by accident. One of the best ways is being a customer of one of them. If you are a customer of a company and you like the product and think it's good, there's often a chance that quite a lot of other people will as well. And that can often be a very, very good way of initially finding a share that might be a good investment. The other way, and probably a more common way that private investors should look for quality companies, is through something called stock screening, where you screen a universe of shares across the UK stock market or any stock market in the world, if you have the right tools, and you look for companies with certain characteristics. And the main ones that I go on in the book and advise people to look for is companies that make very high returns on the money that they invest. So it's called return on capital employed, but it's a bit of a unfriendly term. So I've referred it to in the book as the company interest rate. So just as you would try and put your money in a high interest savings account, you should look for companies that can earn high rates of interest on the money they invest, which is essentially high rates of profitability in relation to the amount of money they actually sink into the business. So that is the primary sort of function of quality that you look for in potentially a good investment. The other one, which is another central theme of the book, is that it's good to find companies that are not only highly profitable, but also are very good at turning those profits into lots of cash. It's all very well being profitable, but unless you actually see the cash as an investor, quite often you can end up with disappointing investments. So those are the two main things that I focus on and suggest that people look for in finding quality companies.
And it's good to hear you talk about the qualitative measures, actually experience a company and its customer service and the quality of its products, as well as some of those quantitative measures around return on capital and profitability and cash flow. Are there any steps that investors should be taking at the moment to be making sure they don't pay too much for company shares? Because I know there's a lot of concern that markets look overvalued and many company stocks look overvalued, certainly by historic measures. What should investors be looking for?
Well, I think the point you raise is a very, very important one. High quality businesses rightly trade for high valuations, and they do that because they are reliable, less risky, and if you hold them for long enough, they can deliver very satisfactory returns for the portfolio that you're running. But as you rightly say, you can pay too much for them. And one of the biggest risks, if not the biggest risk, apart from investing in a bad company, is paying too much for a good company. And I completely agree with you. I think some of the valuations on very good quality companies at the moment are quite hard to justify. When that actually changes, your guess is as good as mine. But in terms of actually trying to protect yourself from paying too much, there are a couple of ways you can do this. I set out a process in the book about how you can set a price for the share based on the rate of interest on government bonds and the rate of interest relative to the rate of inflation. And that's quite sort of involved and a little bit more advanced, but roughly speaking, in today's markets, if you've got a company which is highly profitable, high returns, and produces a lot of those profits in terms of cash, they're a rough rule of thumb that once you're paying sort of more than 20 times earnings or a PE of 20 for these companies, you are starting to get into risky territory. The companies would need to grow very strongly and sustainably to justify that kind of price.
And are there any common shortcuts that investors tend to use when they're valuing shares that maybe aren't as useful as they first appear?
Yeah, I think probably one that's most applicable in current markets is probably the dividend yield. As you probably know yourself, because of the low interest rates on bonds and savings accounts, people have turned to the stock market in return for high income. And buying shares with high dividend yields, high dividend income returns as a percentage of the share price is a common trap that private investors particularly fall into, because the high yield is essentially a function usually of either a dividend that is not sustainable because the business is struggling and people expect it to be cut, or one that is actually not going to grow that much in the future. So it's all very well having a high initial dividend yield, but history tells us that the best returns are made from dividends that actually grow over time. So that's probably the main shortcut and the main sort of pitfall that I would say that investors would do well to stay clear of.
And in your role as an analyst, I've no doubt you've looked through many, many different company accounts, you've looked for information. When looking at a company and its published accounts, how can investors understand what they're looking at, and particularly how can they look for reliable measures of profit?
Very, very simply, you should look at a company over a number of years. For starters, one of the things that you should do to try and understand the business and keep yourself away from dangerous companies is look how a company has performed when times are bad, when there's a recession. And you should look at the profits. And I would suggest look at the trading profits or operating profits of the company and look at how well that they have stood up over time. And if they have gone down a lot in a recession, that suggests to me that that's not really the sort of company that would sit well in a portfolio without keeping you awake at night. So I think it's very important to understand the company's history, how it performs in different states of the world, and then focus on the trading profits of the business as a whole. I know a lot of people focus on something called earnings per share, or the profits for each share. That's probably not the best way to look at it, because of the way that figure can be manipulated by accounting and things like share buyback, shrinking the number of shares. So look at the trading profit, and then also look at the something called the operating cash flow figure in the cash flow statement, and look at how those two compare. So if you've got a company that's been able to consistently grow those trading profits and increase its trading cash flows, that's a sign of a pretty good quality business.
And I think that's such an important tip, because, of course, accounts are just a snapshot of a company's current position. So actually looking back over several years of accounts and seeing how they've performed over time is far more valuable than just looking at it on one particular day, isn't it?
Yeah, definitely. I mean, it's something that I think a lot of investors are reluctant to do, because it can be quite a dry subject, and it can be quite time consuming. But I think, unfortunately, a lot of shareholders do come a cropper by only focusing on the here and now, or some kind of story about the future prospects of the company, without really understanding where the company has come from.
And you mentioned earlier that when a company's valuation goes above about 20 times price earnings, it could be considered risky. Are there any other signs that a company might be particularly risky or even dangerous for an investor? Yeah,
I mean, just going on from the last point, I think any company which has shown a lot of variability in its profitability, i.e. profits that move up and down a lot, that's generally a sign of something that can be quite risky. But I think that the other thing that you need to pay attention to is avoiding companies with lots of debt. And also, increasingly in this world, things like pension fund black holes. One of the most important things to understand when you're an investor in a company and its shares is that as a shareholder, you are last in the queue to get paid. So people who lends to the company, the interest on that gets paid before you get a dividend. If the pension fund needs topping up, that has to be paid before you get a share of the profits. So avoiding companies with lots of debt, unless, of course, it has a very, very stable and predictable earnings. For example, utility companies, tobacco companies, those kind of companies where the profits don't tend to move around too much regarding the economy. Those kind of companies can support a reasonable high level of debt. The danger is when you get companies where the profits aren't as secure and they're loaded up with debt, is when you can get a big problem.
And you mentioned pension fund black holes there. Of course, for many larger companies, pension deficits are a huge issue at the moment, and some really eye-watering and scary figures involved. What do investors need to look for if they see on a balance sheet a big pension fund deficit, and what impact could that have on future profitability, future share price? Yeah,
I mean, generally, you should stick away from companies with large pension fund deficits. And just as a quick rule of thumb, what the pension fund deficit is stated as a liability on the face of the company's balance sheet. And as a rough rule of thumb, if you take that number and compare it by the company's market capitalization, which is the share price times the number of shares in issue, anything sort of over 10% of the market capitalization in form of a pension fund deficit is starting to get uncomfortable. And the thing is as well is that these pension fund deficits, they move around all the time. And, low interest rates have been a real problem for pension funds. And, it's a concern of mine that some of the liabilities that are stated on company balance sheets might actually be a little bit too low, and that the ability of the company to make good on those deficits can be called into question. So in terms of your question about future profitability, it's a big issue, because the liability is very, very uncertain, because it depends on interest rates on investments, how long people will live, how high inflation will be in the future. And there's just no way as an investor that you know what that's going to be. And quite clearly, for companies with big pension fund deficits, they're going to have to set aside a lot of the company's profits and cash flows to make good their promises that they've made to their past, current, and future employees. So generally, it's something to stay away from, and it's no surprise that companies are shutting down final salary pension schemes and cutting the benefits to members, because it has the potential to do immense damage. And as a shareholder, that's something you want to stay well clear from.
Phil, thank you so much for joining us on Informed Choice Radio today. Before you go, where can our listeners find out more about you, and how can they get in touch? And most importantly, how can they buy a copy of your new book? Okay,
I work for a company called Ionic Information, and you can find the articles that I write on a website, which is www.sharescope.co.uk, and there's a tab at the top of the web page with my name on it. All the articles are free. You don't have to be a subscriber to our product to buy them. They're there for everybody. And in terms of the book, the best place to buy it is to go to the Harriman House website. I've got a very good deal on the book at the moment. And if you buy the paperback version, you get a free ebook as well. So that is probably the best place to go and buy the book if you want to read it.
Fantastic. We'll make sure we put links to all of that into the show notes as well, so our listeners can find it nice and easily. Phil, thanks for your time.
Pleasure, Martin. Thank you.
A big thank you to Phil for joining me on Informed Choice Radio today. What factors do you consider when picking company shares and investing your money? Let me know on Twitter at Martin Bamford, or in the comments section in the show notes for this episode at icradio.co.uk. That's also where you can find useful links, and you can download the full transcript for this episode. I've got 2 copies of Phil's new book, How to Pick Quality Shares, to give away to listeners of Informed Choice Radio. To enter this free prize draw and stand a chance of winning a copy of the book, just follow the simple instructions in the show notes for this episode at icradio.co.uk. The competition closes at midnight next Wednesday, the 14th of June. Just visit the show notes for this episode at icradio.co.uk and enter there for your chance to win. Before you go, please do take a moment to share this podcast episode with a friend on Twitter, Facebook, or LinkedIn, or anywhere else you go online. Each time you share an episode on social media, it helps us to boost us up the podcasting charts, and it helps us to reach even more new listeners. And if you've not done so before, please do leave us a quick rating and review on iTunes. In fact, even if you've left us one before, we always welcome another one, so you can leave more than one. Please visit icradio.co.uk/iTunes. That'll take you straight to our page on Apple Podcasts. Click on the tab that says ratings and reviews, and that's where you can leave us your 5-star rating and a short review there. It just needs to be a few words. We read out every review we're left in a future episode of the podcast, so please do leave us a review. Leave us a note of your real name if possible, and we'll read you out in a future episode. Thank you for listening to this episode, and thank you for your continued support of this podcast. Until next time, I'm Martin Bamford, and this is Informed Choice Radio. And remember, when it comes to your money, the more you know, the faster it can grow.
you.